Top 5 investment types ranked from safe to risky. Investing wisely means understanding both the upside and the downside of each opportunity. The safest investments tend to preserve your capital at the expense of lower returns, while riskier assets promise higher gains but expose you to greater losses. By matching your choices to your goals, timeline, and comfort with volatility, you can build a portfolio that grows without losing sleep. Here are the 5 major categories of investments, ordered from safest to riskiest, each introduced by its core advantage and drawback. 5. Maximum safety, high-yield savings accounts, and government bonds. When absolute capital preservation is your primary goal, nothing beats the combination of high-yield savings accounts and government bonds. High-yield savings accounts function like regular bank accounts but pay interest rates well above the national average, often in the 3 to 5% range. Because they are FDIC insured up to $250,000 per depositor, your principal is virtually guaranteed. Government bonds, particularly those issued by stable governments such as U.S. Treasuries, offer similarly low risk. You are effectively lending money to the government in exchange for periodic interest payments and the return of your principal at maturity. While yields on these bonds are modest, the certainty they provide makes them ideal parking spots for emergency funds or short-term goals. The trade-off, of course, is that their returns often fail to beat inflation over the long run, which means your purchasing power can erode if you leave money parked here indefinitely. 4. Low risk, long-term growth, index funds, and ETFs. For investors who want market exposure without the stress of picking individual stocks, index funds and exchange-traded funds, ETFs, offer an attractive balance of risk and return. By tracking broad market indices, like the S&P 500 or a total market index, these funds give you instant diversification across hundreds or thousands of companies. This diversification smooths out the extreme swings you'd see holding any single stock. Historically, broad U.S. market index funds have returned between 7% and 10% annually over multi-year periods. While you will experience occasional market downturns, the daily day-to-day volatility is absorbed by the fund's wide reach. Low expense ratios and minimal trading requirements make index funds and ETFs particularly appealing to beginners or anyone looking for a set-it-and-forget-it strategy. Their primary drawback lies in their vulnerability to overall market declines. If the market tumbles 20%, so will your fund's value, though it typically recovers over time. 3. Moderate risk, tangible asset, real estate. Real estate occupies a middle ground between the stability of bonds and the growth potential of stocks. When you own a rental property or invest in a real estate investment trust, REIT, you gain 2 avenues of return: rental income and property appreciation. Rent checks can provide steady, monthly cash flow, while the property itself often rises in value over years or decades. Tax advantages, such as deductions for mortgage interest and depreciation, further enhance real estate's appeal. However, real estate is capital-intensive and illiquid. Acquiring property generally requires a sizable down payment, and selling it quickly can be difficult or costly. Landlords face the ongoing responsibilities of maintenance, repairs, and tenant management. Yet for investors willing to tolerate these challenges, real estate offers a powerful hedge against inflation and a diversifying asset that behaves differently from stocks and bonds. 2. Higher risk, higher reward. Individual stocks. Investing in individual companies can yield spectacular gains, but also steep losses. When you buy shares of a single stock, you are betting on that company's success. If the business thrives, your returns can far outpace those of broad market indices. Conversely, if a company falters or the sector falls out of favor, your investment can plunge, sometimes to zero. Success in stock picking demands time, research, and emotional resilience. You need to analyze financial statements, assess competitive landscapes, and stay abreast of market and macroeconomic trends. Even seasoned professionals get it wrong. Nonetheless, for investors who relish the challenge and understand that volatility is part of the game, individual stocks can be the engine of extraordinary portfolio growth. The payoff comes only if you can stomach the ups and downs without panicking. 1. Maximum volatility. Cryptocurrencies and speculative assets. At the far end of the risk spectrum lie cryptocurrencies and other speculative assets, such as non-fungible tokens, NFTs, or meme stocks. Bitcoin, Ethereum, and their myriad rivals have demonstrated the power of rapid adoption. Early investors in some digital currencies saw returns in the thousands of %. Yet these markets are unregulated, operate around the clock, and can swing 20 to 50% in a single day. A single tweet, technical glitch, or regulatory announcement can trigger extreme price moves. Cryptocurrencies are underpinned by promising blockchain technologies, but they lack the government backing and intrinsic cash flows of traditional assets. Speculative manias can drive prices far above or below fundamental values, leading many investors to lose large sums. If you decide to allocate any capital to crypto or similarly speculative instruments, it should be an amount you can afford to lose entirely, and you should be prepared for wild price gyrations. Balancing your portfolio. There is no universally correct mix of these 5 investment types. A prudent approach begins with assessing your time horizon, financial goals, and emotional tolerance for risk. Young investors with decades to invest can afford higher allocations to riskier assets like stocks or crypto, while those nearing retirement often shift toward bonds and savings accounts for stability. The clearest lesson is this: diversify. By spreading capital across multiple asset classes, you reduce the chance that a single downturn wipes out your gains. Over time, a well-balanced portfolio, tailored to your personal circumstances, will deliver both growth and resilience, guiding you steadily towards your financial goals. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.